Uh, where the hell did bloody hell? Where is it?
We're live.
I know we are. I just can't find. Oh, there we go. Wait, damn it. What the hell?
When in doubt, alt tab.
I'm okay. I'm okay. I think we're all set. Okay, here we are. Okay. Welcome to Dis and Dat. We're up to Hudson, chapter 8. Stock market is a predatory arena. Today, the Fed cut rates by half a point. This should be pretty interesting. We could argue that the Fed has decided to do this to put its thumb on the election, but whatever. I'll let people argue that particular point. They've signaled more reductions, probably another half point before the end of the year, perhaps. This is quantitative easing at work, and hopefully no craziness will occur. That's one thing. And this morning, I attended a Zoom lecture in Finland, and fortunately, 4:30 in the afternoon in Helsinki is only 9:30 in the morning here. So the thing I was looking at was a fellow who really interesting guy. He's at the Institute for New Economic Thinking, INET. Name's Doyne Farmer, or J. Doyne Farmer, and he's got an endowed chair, and he's actually made a shit ton of money. Excuse me, a lot of money with his predictive model stuff. What he was explaining today was complexity economics. I put some links in the misinformation section in Discord, and you can see his stuff. Just an interesting guy. I mean, and an American. I mean, he's he's just an interesting guy. He sort of has developed the larger agent-based modeling of something I was interested in a couple of decades ago. But you start picking up stuff, and you try and look around for someone who's going to actually support you doing this, and there's nobody around to help you. So it just academia really sucks. But the interesting thing is that Doyne Farmer actually shares that opinion. He's quite a most of his stuff is sort of saying, well, mainstream economics does it this way, and he was very upfront about, if you follow this kind of path as a researcher, you're not going to get a job at Harvard. He said that today. That was pretty interesting. He was pretty brutally honest about, well, this is pretty out there. And so it's needless to say, if he's doing work at INET, it is radical stuff. And he's talking, mainly about applying sort of complexity theory to economic behavior. And his example was to study the kind of net effects, the effects of COVID on certain labor categories and demand categories. And so he did the nice thing is that COVID allowed for doing a massive complete modeling of for example the British economy, and I think he got some money from the Brits to do it. And it's quite interesting to see what Oxford is at, all that quant stuff that they're doing, and also the internet stuff. So it's all, Oxford still, leads the pack in that sense, and also open to, much broader kind of research programs. So it's all very, very fascinating. He was quite open to, well, we do geography and we do computer science and math, and we have a bunch of people that do this kind of math, and we've got a Bayesian, blah, 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 blah. It's really quite amusing. I don't know if they're going to show this, but I think he has a kind of, this was his sort of public rap. I mean, he didn't indulge the math at all. He just showed a bunch of graphs and showed how it's all kind of interconnected, and it was relatively easy to understand. And he has a new book that came out in April that is, I'm going to see if I can get a digital copy, and it's on Audible if you really want to. I'm not sure that listening to it really tells the tale. It's the kind of thing that where reading is more important than listening. But anyway, so those two things today. Today was an interesting day for that. They didn't answer my question, which was I put a little thing on the question thing, but they were much more excited about people showing their faces and yammering the question. So anyway, although it was technically answered because he actually was quite versed in why it was or wasn't a Marxian model, and since he spent time at Santa Fe, he would actually know some of the like Bowles and Gintis, who were at also at Santa Fe, the Santa Fe Institute, where they do a lot of this kind of economic modeling. All right. Anyway, he didn't have anything nice to say about mainstream economics, so it was sort of amusing for a guy from Oxford. Chapter 8, the stock market is a predatory arena. It's rare, one is told, for an American to invest, as many Englishmen still do, for income, and he will not readily purchase an investment except in the hope of capital appreciation. He is, in the above sense, a speculator. Speculators may do no harm as bubbles on a steady stream of enterprise. But the position is serious when enterprise becomes the bubble on a whirlpool of speculation. When the capital development of a country becomes a byproduct of the activities of a casino, the job is likely to be ill done. And this is John Maynard Keynes from the masterwork, The General Theory of Employment, Interest, and Money of 1936. So Hudson, Wall Street paints its activities in as positive a light as possible, as if to justify its enormous salaries being earned productively rather than at the economy's expense. This smiley face picture also serves to rationalize its tax breaks and, most recently, its bailouts. Academic models echo a view of the stock and bond markets raising funds mainly for new industrial investment, innovation, and employment while making savers richer. Yet, finance rarely ever in history has ever played a productive role funding capital formation in industrial plants and equipment research and development. In fact, since antiquity, workshops and factories, farms, and other capital assets traditionally have been self-financed. Until the early Industrial Revolution, the means of production were owned outright. The idea of productive credit to finance new investment in means of production was an alien concept down through the mid-19th century. And even then, the investment was mainly for railroads and canals, not industries or infrastructure. Credit arrangements were used to bridge the time gap between production and sale, between planting and harvesting. We talked about this in the last chapter, and especially for commerce over large distances, but not to invest in manufacturing. This strategy remains in effect today. Most U.S. and European corporations pay for their capital investment out of their current earnings, not by borrowing from bondholders or banks. This is the issue of why you have this sort of submarket of venture capitalists or whatever. The financial system extends credit mainly to buy property already in place, from real estate, the focus of most bank lending today, to entire companies. This shift in ownership adds to debt without increasing output, merely, transferring ownership. And let me stop for a second. This is the whole issue of, as I was talking before, about the new institutional economic history, which discusses this is Williamson's argument about transaction costs being really the big deal and more important than anything else. Existing stock owners are bought out by new owners who issue high interest bonds and borrow takeover loans from banks. And corporations borrow increasingly to buy up their own stock and even to pay dividends, creating gains by inflating asset prices. This whole business that we've been talking about and the failure of the 2008 is this, one of the elements is this asset price. So in this article, Hudson, in this chapter, Hudson talks about Apple, sort of the rise and fall, but Apple's a key player in sort of shaping the current, kind of economy, the way it's sort of been. And as much as we'd like to say, well, how many of us use Macintoshes, blah, 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 most of the kind of, there was a certain sense of its role in the massive economy. And in fact, you can contrast Apple with IBM in terms of, sort of the way the kind of business model operated. And most of us know this story, Apple's closed system, blah, 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 whereas IBM had you could call it open. It's not really open, in terms of development of software and multiple platforms and CPUs and blah, blah, blah. Apple is a case in point. In 1980, the computer company went public with a $100 million initial public offering of shares. That's an IPO. The largest U.S. IPO since that of Ford Motor Company in 1956, a quarter century earlier. The stock sale set a record by making 300 instant millionaires within its own ranks, including 40 employees and early investors for their 3 years of work to build up the company before it went public. This is that whole thing about Silicon Valley. Founded in 1977, Apple required funds to invest in more production facilities and to buy companies with complementary patents that it needed to expand. However, Apple only received a portion of the proceeds of this stock issue. Its underwriters, headed by Morgan Stanley and Hambrecht and Quist, initially priced the stock at only $14 a share, but enough orders poured in to price it up to $22 by a share by the opening bell. Being oversubscribed, given the underwriters' low pricing, the lowballing it, Apple's price rose by 32%, ultimately to $29 a share, valuing the company at $1.8 billion by the end of the day. A first-day jump means that the company's stock is worth more than the underwriter promises to raise. This underestimation of the market enables early subscribers, so-called preferred customers, usually institutional investors and a few prominent individual players, to make a killing. Giving them a chance to buy low-priced shares to turn around and sell at a price gain during the first few hours of hectic trading helps the underwriter attract a loyal following of investors. The bigger the hit-and-run windfall the underwriter can offer these clients, the larger a client base it builds up for future offerings. This investor base is permanent. Most companies issuing new stock are only one-time hits, so underwriters lowball their promises to companies going public. The result is that financial speculators make more than the companies actually create in real value. Underwriters thus have a conflict of interest with the companies whose stock they float. In addition to charging their underwriting fee as high as 7% for new businesses, the more they understate what a company is worth, the bigger the gains they and their favored customers quickly make by flipping its shares to a later buyer at the more reasonable market price established by the end of the first trading day or week. A successful issue is one where the stock price may double from the opening to the closing bell. Company officers, venture capitalists, and other initial long-term holders will see the value of their shares rise, but the company itself receives only the opening sales price. The underwriter and its clients may end up making as much on the sale that it orchestrates as the company and its founders receive for all the years of effort that they put into creating the business. Yet in this case, there was so much money to be made selling computers that Apple viewed being exploited by its underwriters simply as the price of doing business on Wall Street. And this is how the financial world works. Apple went on to be immensely profitable. Now, it's a bigger story, right? It becomes profitable, but then it has all these other little strange glitches and organizational issues and John Scully and a bunch of other things until you get the iPod, blah, blah, blah. But this success led to yet another example of how the financial sector's interests had become antithetical to those of industry over the past generation. So let me stop here. This carries what we were talking about before, the difference between a kind of industrial approach to this and financialization, and that they're not in harmony, and that there is a bias, mainly because of profit, and that does not emphasize enough industrial capital in that particular context. Now, you could say that's sort of a Marxist thing, But in reality, you could actually say that, relative to, economic growth, et cetera, this is more of a kind of, as we were talking about yesterday, the difference between British banking and German banking, this whole thing of getting rich quick, to oversimplify it. Okay, back to the text. Apple's plague of activist shareholders, formerly known as corporate raiders. Once a company has issued stock to the public, financial managers and activist shareholders jump into the game to turn it into a cash cow. Activists we normally think of as political. This is simply activists, meaning they're just really engaged in this. Instead of plowing profits back into the corporation to expand the business by new long-term investment, research, and development, the company is urged to pay out its earnings as dividends and buy back its stock to bid up its price. This is kind of the whole story we've had for several decades. The aim is to enable speculators to make trading gains. Towards this end, activist shareholders have even tried to force Apple and other cash-rich companies to take on debt they don't need for productive investment, merely to spend on stock buybacks. At issue is a conflict that was characterized a century ago as being between industrial capitalism and finance capitalism. Apple CEO John Sculley chose to spend $1.8 billion in the late 1980s and early 1990s to buy back its own stock to support its price. That was money it really could have used when the company then stumbled and needed to issue junk bonds and issue $150 million in convertible preferred stock to Microsoft just to survive. That was a bad day for some loyalists. Many other companies found themselves similarly squeezed by buying up their stock at high prices only to see prices later fall. In effect, their earnings were stripped and new capital investment or expansion foregone simply to make temporary gains for stockholders. This is a strategy that activist shareholders, quote unquote, have been urging Apple and other companies to do today, to use their earnings to buy its stock instead of making new tangible investment and even to go into debt to finance stock buybacks. You can see what's going on here. It's not about, sort of true innovation, but rather, accumulation, right, of a very primitive sort. Now, why should a company as cash rich as Apple take on debt? If ever a company has not needed to borrow to fund new research and development, hire more employees, or invest in new plant and equipment, it would seem to be Apple. As of August 2013, the company was sitting on a $137 billion mound of cash. Yet, despite having been the highest valued U.S. company by 2012, $626 billion, with annual sales of $156 billion, Apple has become one of the leading targets of such short-term financial predation, right? Predation is going on here. And you can see this because, you'll see this if you recall kind of Carl Icahn, Trump sucking up to Carl Icahn somewhere during his administration. By 2013, Apple's soaring earnings attracted speculators like hyenas to raw meat. Activist shareholder Carl Icahn, a leading corporate raider since the 1980s, bought over $1.5 billion of Apple shares and mobilized a group of fellow financiers to demand a debt-leveraging ploy that he forecast would raise Apple's stock price above its 2012 level of 525 by amassing enormous debt to engineer strictly financial gains. Icahn had made his first fortune by raiding TWA in 1985. Note that TWA, the airline, does not exist anymore. He paid off the debts that he took on to buy the airline by carving it up and leaving it bankrupt. By 2030, he had done the same kind of financial smash and grab exercise often enough to create a vast pool of hedge fund capital, which he wielded to attack companies and make money off money. Speculators such as Icahn search for cash-rich companies as the most lucrative targets for making a quick gain by using whatever is in the corporate treasury to bid up their stock price with share buybacks. The operation is strictly, purely financial, not involving any new business investment or other production advantage, such as went into the creation of the Macintosh computer, iPhones, iMacs, iPods, and iTunes. No information technology or sales strategy is involved. It is simple financial engineering. Low interest loans at 3% to buy company stock, bidding up its price. This is a no-brainer to go buy stock in a company that can go borrow. Icahn explained the lower the interest rate, the larger amount of debt, that is new borrowing, that any given earnings flow can carry. And Apple's earnings were immense. Apple's management had no particular need to pay out more dividends to establish a basis for future stock offerings. Its production and research are self-financed out of its earnings, and its capital reserves are large enough to fund any acquisitions it might need to make. Maintaining its growth calls for using its capital reserves and earnings to acquire companies that own complementary information technology patents or marketing power, and also to expand its own production facilities and long-term research and development. You know, in the early history of Apple, you know, we all went ooh and ah over the huge supercomputer that Apple invested in, Cray, I think. You know, it was nitrogen cooled and blah, blah, blah. And that was impressed so many people. That is what a growth company does. Paying out earnings as dividends or using them to buy back a company's own stock does not facilitate future sales or profit. All it does is leave fewer shares outstanding so that earnings per share and hence potential dividend payouts will be higher. That is what Carl Icahn, promised would raise Apple's stock price so that even without earnings growth, we think it ought to be worth, you know, $625 a share. Indeed, Apple's stock price rose 5% simply on the news of his buying into the company. It was a signal to Wall Street that a financial feeding frenzy was about to begin. In September 2013, Carl Icahn increased his stake in Apple by about $500 million to more than $2 billion, about 0.5% of Apple, and demanded that the company spend $150 billion to buy back its shares. This interesting way of leveraging. He had a large enough following among Apple shareholders and speculators that after he sent out a tweet that he had spoken to its CEO, Tim Cook, to suggest this, Apple's shares rose 2.2% to $487.12, producing a one-day gain of $40 million just for Carl Icahn alone. The company already had promised to pay $100 billion in dividends and undertake the biggest buyback any company had ever announced, that is $60 billion over the next 3 years. But while this may seem like a large buyback, Carl Icahn wrote, it is simply not large enough given that Apple currency holds $147 billion of cash on its balance sheet. By February 2014, Icahn ended his efforts, claiming to have won the battle inasmuch as Apple had stepped up its stock repurchases so close to fulfilling our original repurchase target, that is $40 billion over the preceding 12 months, a record for U.S. companies, with $14 billion in just the 2 weeks preceding its quarterly earnings report. Apple's earnings were slowing, and the stock price fell back, but not by as much as it would have occurred without this $40 billion removal of shares from the market. As Dakota, on April 29th, remember this is during the Obama administration, despite holding $150 billion in cash, Apple borrowed $12 billion and used the entire sum to buy back its stock, having borrowed $17 billion in the bond market the preceding April. Its stock, nonetheless, fell $1.76 the next day to $592, valuing the company at about $512 billion. The moral is that stock prices rise and fall, but only tangible capital assets and debt remain in place. But the financial world lives in the short run, not the long run, and Icahn's barbarians at the gates took their gains and ran. Financial engineering versus industrial engineering. Stock buybacks are changing the character of industrial capitalism. Using earnings to repurchase a company's stock bids up its price, but diverts earnings away from being invested to expand the business. This is the trade-off that's going on, which stifles, larger systemic economic growth. During the 1990s, for instance, IBM typically spent $10 billion of its earning each year just to buy its own stock. The company also borrowed. So in effect, it was borrowing to bid up its stock price instead of to expand research and development. The whole business of IBM during this period is to convert itself from, a maker of computers to something else, services of computer services or servers or whatever, something else at more systems related stuff. This policy led it to outsource research and development for its software, leaving Bill Gates and Microsoft to make the fortune that IBM would have obtained if it had used its earning for in-house investment instead of buying back shares it had long since issued. IBM continued this policy during 2000 to 2014. It spent some $180 billion on its own shares. It also paid out $30 billion in dividends to help finance the share buying spree. IBM loaded up on debt. While the company spent $138 billion on its shares and dividend payments, it spent just $59 billion on its own business through capital expenditures and about $32 billion on acquisitions. All of which is to say that IBM has arguably been spending its money on the wrong things. That is, shareholders, rather than building its own business. IBM's financials make it self-evident that its stock rigging strategy is not about value creation through investment. David A. Stockman, the director of the Office of Management and Budget under Ronald Reagan, IBM is a buyback machine on steroids that has been a huge stock market winner by virtue of massaging, medicating, and manipulating its earnings per share. Basically, the company's share buybacks announced to the world that IBM was no longer a growth company and would not think of a new avenue to develop in-house that would be more remunerative than using its flow of earnings to liquidate its share ownership. It ended up selling its laptop personal computers to Lenovo in China, concentrating on its traditional large hardware market. This is not a long-term growth strategy, but it enriches financial speculators during the period in which the company is burning up its shares. The key to creating wealth in this purely financial manner is simple mathematics, that is, interest rate arbitrage. The idea is to borrow at a low rate, the 3%, for example, the 3% at which Carl Icahn claimed Apple could obtain credit, and buy shares yielding a higher return on equity, say 10%, and pay out the 7% difference to shareholders, where debt replaces equity. So this is, it's like a shell game. It is a kind of system of deferrals, and it is a kind of, you could say it's a kind of capital turnover, but it not quite that. This is why debt equity ratios have risen for corporate America. It's symptomatic of the economy's overall rise in debt income and debt GDP ratios. By 2004, Standard & Poor's reported that the S&P 500 companies spent $197 billion on buying back their own shares. The pace of buybacks accelerated to over $100 billion a quarter by 2006, by which time 268 of the companies in the S&P 500 bought back shares in the first quarter, with nearly 110 of them cutting their diluted shares outstanding by at least 4% from a year earlier. That is, ExxonMobil Corporation, Microsoft Corporation, and Time Warner Inc. were the biggest buyers of their own shares during the first quarter of 2006, spending $14.37 billion combined, prompting a Wall Street Journal report to conclude a company that aggressively buys its own shares on the market can give investors a skewed picture of its earnings growth. When a company reduces its shares outstanding, it will report higher earnings per share, even if its total earnings don't grow by a penny, simply because those profits are spread across fewer shares. And this is shell game. ExxonMobil's net income rose 6.9% in the first quarter, but that turned into a 12.3 earnings per share increase after share buybacks, according to Standard & Poor's. Creating financial wealth by debt leverage instead of new tangible investment. That's the story here. A recent Harvard Business Review article calculated that for the decade 2003 to 2012, The 449 companies publicly listed in the S&P 500 index used 54% of their earnings, a total of $2.4 trillion, to buy back their own stock, even more than the 37% paid as dividends. This left only 9% of earnings available for new capital investment. Summarizing the article's statistics, a Financial Times columnist noted 7 of the top 10 largest share repurchasers spent more on buybacks and dividends than their entire net income between 2003 and 2012. In the case of Hewlett-Packard, HP, which spent $73 billion, it was almost double its profits. Others, such as Microsoft, 125%, Cisco Systems, 123%, and Intel, 109%, were even more extravagant. This management strategy created financial wealth by elevating the stock price, not by producing more goods. Earnings per share rose not because companies actually earned more, but because there were fewer shares outstanding among which to spread the earnings. This is the generalized story that we have for this period. Many of the companies downsized and outsourced their employment and production, needless to say. They sent it somewhere else, Asia, for example. The immediate beneficiaries were corporate officers exercising their stock options. These accounted for 42% of executive compensation, with a further 41% coming from payment in the form of stock awards for the 500 highest paid executives in 2012. This averaged out to about $30.3 million apiece, with over 80% coming from stock options and bonuses tied to their price performance. In effect, companies were buying up the stocks created to reward these executives, supporting their cash price, and the executive rewards themselves were linked to the stock price. No wonder management pursued this easy self-enrichment policy. You have Boeing, actually, you can see some of the, Boeing is having this trouble, but on the other hand, executives are still making a heck of a lot of money. Many executives even pushed up their stock price by borrowing to buy up their shares and then hence earning higher performance bonuses tied to the price rise. So you're just manipulating it a little bit more and you get even more back. A very positive casino. The debt incurred will have to be serviced by future earnings, Paul Craig Roberts pointed out. This is not a picture of capitalism that is driving the economy by investment. Well, why should investors buy into a company that isn't investing in its own business? The explanation is that financial engineering has replaced industrial engineering. Stocks of companies whose managers use earnings for share buybacks have outperformed those of those old-fashioned industrial companies that reinvest their earnings in tangible capital formation and new hiring to expand sales. That seems fairly obvious, hopefully. Unlike the corporate raiders of the 1980s, infamous as barbarians at the gate leveraging other people's money to fund takeovers, today's corporate executives raid their own company's revenue stream. They're backed by self-proclaimed shareholder activists. The result is financial short-termism by managers who take the money and run. The management philosophy is extractive and not productive in the sense of adding to society's means of production or even living standards. The Federal Reserve's policy of quantitative easing, like what happened today, implemented in 2008, creating more bank reserves to lend out to buy assets, has made it increasingly profitable to borrow from banks at lower interest rate, buy stocks whose dividends yield a higher return, and pocket the difference. This interest dividend arbitrage pushes up stock prices by steering more bank credit to enough capital gains to cover what is paid in dividends as bank interest. Since its post-crash low of March 2009, the S&P 500 stock index nearly tripled, while average wages and other economic indicators stagnated in the wake of the debt overhead left in the wake of the wake of the financial crisis. But in the process, the stock market, indeed the corporate sector, becomes more highly indebted, the same scenario that ravaged the real estate market. This is why Trump has this thing for a growing stock market. This is not new. As early as 1910, Rudolf Hilferding's finance capital described high finance as extractive. property ceases to express any specific relation of production and becomes a claim to the yield, apparently unconnected with any particular activity. The effect of financialization is to divert corporate cash away from investment and job creation. In the wake of this debt inflation described below, it's the rich are getting richer and the poor getting poorer. It's the same deal for decades. Federal Reserve Chairman Janet Yellen said, she's currently the Treasury Secretary, it speaks to the depth of damage that 5 years after the end of the recession, the labor market is yet to fully recover. Such recovery is not the aim of financial engineering. Most corporate strategists view low wages as a benefit, not a detriment. It seems fairly obvious. Yet, as far as academic economics is concerned, higher dividend payouts should not matter. The Modigliani-Miller theorem, that is named for Franco Modigliani and Merton Miller, deems dividends irrelevant by proving mathematically, in the way that economists do, that payout ratios make no difference in stock valuation because investors are smart enough to treat the rise in book value stemming from capital reinvestment on the same plane as dividend payouts. This principle that dividend yields make no difference in stock pricing is mainstream business school teaching. This is this kind of relative autonomy that contradicts what, how value actually gets created, but that and it is a canon of the literature. If the academics are right and high finance is all knowing and a wise allocator of resources, would corporate raiders exist? The Modigliani-Miller portrait of investors ignores the financial maneuvering to raise stocks in the short run to reward these hit and run speculators and managers whose bonuses are tied to stock price. Investors may be smart, but are they really interested in taking the long-term planning role that academic economists wish they would do? Or do they just want to liquefy assets, take the money, and run? A company's cash position does not improve from higher stock prices unless it plans to issue new equity at the higher price, which has not been happening. Also, rising price earnings ratios mean lower dividend yields for new buyers. The investment focus shifts away from investing to expand business and earn more to seeking capital gains. These asset price gains, and this is about regulation as well. This is about, and tax policy. It's about a whole bunch of things all going on at the same time that the state can actually do something about. These asset price gains from financialization do not increase tangible wealth. They're leveraged by rising debt levels. And because interest payments are tax deductible, turning profits into interest payments has the fiscal effect of deepening government budget deficits. Hence why we're interested, in modern money theory, because we can actually blunt some of this. At the 50% corporate tax rate of the early 1980s, companies were able to pay out twice as much of their earnings in the form of interest to creditors than they could pay in dividends to stockholders. The tax deductibility of interest led stockholders to be replaced by bondholders, especially junk bond holders. And this is why, we got into that spiral thing. If equity was replaced by debt, the tax subsidy for debt over stock market financing is a major catalyst to debt leveraged buyouts, LBOs, and share buybacks. This new breed of corporate raiders and financial engineers pay themselves interest and produce capital gains with the profits hitherto shared with the federal, state, and local tax collectors. The government budget deficit deepens and the Treasury issues more bonds and looks to raise taxes from labor and consumers. It's all shifting the burden around. The entire economy becomes more debt leveraged, paying income to creditors, headed by the 1%. Instead of investing it or spending to raise living standards. This phenomenon is the major theme of this book. That is, the entire economy becomes more debt leveraged, paying income to creditors, headed by the 1%, instead of investing it or spending to raise living standards. So This is now not how financial systems were expected to evolve a century ago. The Industrial Revolution inspired a long debate on how best to mobilize banking and finance to fund capital investment, by debt or by issuing equity stock. Debt takes the form of interest-bearing stocks or bonds. The interest payment is stipulated in advance, regardless for how much the business earns. The alternative is equity ownership in the form of saleable partnership slices. Stocks usually pay higher returns because dividends may be cut back when business turns down. This is what makes equity ownership claims safer for the company to issue. This equity ownership thing, we were talking about Saint-Simon prior. Debts require interest to be paid at a stipulated pace without regard to what the debtor earns. If a payment is missed, creditors have the right to foreclose on whatever assets are pledged as collateral. To protect themselves, debtors keep a liquid savings cushion on hand to cover the risk of declining income. Paying interest and amortization thus leaves less available to spend. The virtue of financing companies by issuing shares is that companies free of debt can use their income for whatever they wish without having to first pay the bank or his or her debt. Also, shares and equity ownership, that is, stocks in a company, are as long-term as the company remains in business or until the company buys them back. But bank loans are extended for relatively short periods and take the form of a line of credit, like a credit card, that bankers can call in at their discretion. Now, banks hesitate to finance new ventures. They prefer to lend against collateral on which they can foreclose if debtors cannot meet their scheduled payment. This obliges debtors to keep liquid savings on hand, leaving less for current spending. In antiquity, debtors who could not pay fell into bondage to their creditors. That is the original literal meaning of bond, a fetter imprisoning the debtor. Now that debtors' prisons have been phased out, creditors have recourse to the debtor's property and future earnings. Homeowners pledge their real estate to back their mortgage debts. Companies pledge their assets. And clients of payday loan sharks pledge their kneecaps. The problem is that instead of raising capital to fund new capital investment and avoid debt, the stock market has been turned into a vehicle for debt finance takeovers, replacing equity with debt. Starting with the high-interest junk bonds issued from 1977 onward, a class of raiders and buyout kings like Carl Icahn emerged to become Wall Street's most lucrative market. Financial empire builders borrowed from banks and institutional bond buyers to buy out existing stockholders. Takeover financing pays an interest rate premium because of the relatively high risks that the process will drive targeted companies bankrupt, or at least will strip their capital, this asset stripping, and slow their growth by raising their debt equity ratio. Now, this process is called debt leveraging. It has been welcomed as wealth creation, as if it enriches the economy rather than leaving less for new investment and hiring. Chapter 9, the next chapter, explains how the stock market has evolved and how today's financial system has become parasitic and diverged from the path that was expected a century ago to focus on rent extraction instead of industrial finance and to create wealth by financial engineering to create short-term capital gains rather than by enhancing the economy's production and viability. I included a little thing here by Mazuoka, and I included a copy of what I was listening to today by J. Dwayne Farmer on making sense of chaos, a better economics for a better world, which is his sort of more popularized version of how complexity economics operates and agent-based modeling. Okay, so that's the end of my yakking. Let's see if there are any questions, comments, brickbats. No, nobody said anything. There's nobody left. Oh, there's people left. Hello. Comments, anyone? Questions? I can't, I'm not a finance person, so not that this is opaque to me. I sort of understand it, but I sort of wish, there's just a moment when I just didn't want to do this stuff in my career.
Yeah, I have a question, Ann.
Sure.
This is all this stuff was made legal in the 80s, I guess, under Reagan. Is anybody talking about reversing it so that buybacks aren't illegal or illegal again, and compensation with stocks are not legal?
Well, it would be nice if there were more regulatory controls over this, but there aren't. I mean, and the trouble that we saw, I mean, just people weren't paying attention. And you have I mean, the regulators are actually there, but they just don't do anything, which is the very
Well,
frustrating.
I thought that was, it was made legal to do this before
Yes,
it wasn't. So
yes.
the regulators don't have any power to enforce anything. I mean,
No,
there's
they
nothing to
should.
enforce.
They should, but they don't. Yes.
Yeah. Right.
This is just, the extent of how neoliberalism since the 80s has generally, driven the things that would normally keep a control over these things, out there. I mean, well, to go back to Bankman-Fried, I mean, you don't really discover it until somebody suddenly discovers, oh, this guy is really screwing everyone over, and I want all my money back, you know. And fortunately or unfortunately, one rich guy really wanted all his money back to just, he knew this guy was out of control. And I guess he gets 25 years in the clink. Although nobody talks too much about Sam Bankman-Fried these days.
Yeah, what happened? He's going to prison, or he's in prison?
I don't even know if he is in prison,
Interesting.
but I think he got 25 years, whatever. I think they're still working out the deals for his co-conspirators who all, threw him under the bus. Okay, seeing no other, I know is fairly complicated stuff, but I think what's used for this is what Hudson is describing is sort of the generalized history of what went on here. It's not that controversial. This is not a Marxist, looking for the villain sort of deal. It's kind of how it operated. And so the history of these operations are just, on the one hand, it is how capitalism operates. On the other hand, it was, totally built on bad ideology, a lack of regulation, political payoffs, and all of that other shit that hasn't been fixed. I mean, members of Congress can still invest, right? There is some accountability they put in that whatever that accountability act, but it's not really. I mean, it's not that effective. Let's put it that way. Our little democracy is not quite as democratic as we'd like it to be. Okay, let me shut off